18 now. Let's start with the big global news. There was a lot of anticipation building that inflation in the US would moderate, or rather would moderate in April. This was evident in the fall in bond yields that you saw over the past couple of sessions. But it turns out that consumer price inflation that is measured by the CPI came in higher than expected at 8.3% in April. It was pegged, remember, at 8.1%. That was the consensus estimate. So while it has moderated from the 8.5% in March, it has still been seen as a bit of a disappointment. Now, this must all be seen in the context of recent moves in risk assets, not just in the US but globally, and also how the treasuries have moved in the recent past. Like I mentioned, equity markets have fallen quite dramatically since the last Fed meeting, and they continue to remain under pressure even as we speak. Key in the data that was released today is the fact that core CPI, which is everything apart from food and fuel, gained as much as 6.2%, and that was also higher than the consensus estimate of 6%. Joining me now to talk about the implications of this and how markets are viewing this is David Madden of Equity Capital, who's joining in from London. Thank you so much, David, for taking the time. The print higher than was broadly being anticipated, that is being seen as a negative evidently by the equity markets. But could you zoom out and tell us what the implications of this could be from a monetary policy stance as well?
Well, from a monetary policy stance, it really kind of adds weight to the argument that the Federal Reserve should continue down the path of tightening its monetary policy. Only last week, we saw that the Fed take the kind of really drastic measures of hiking interest rates by 50 basis points. And although the update wasn't as hawkish as initially expected, there has been chatters and murmurs since that the Federal Reserve might look to announce further 50 basis point interest rate hikes in the kind of meetings ahead. It was only yesterday we heard from Loretta Mester of the Federal Reserve, who said that she would actually be in favor of voting for 50 basis point hikes at the next two meetings. So with commentary like that, traders are now looking at every important economic report out of the US and thinking to themselves, are we going to have more and more central bankers edging towards a further couple of interest rate hikes of 50 basis points? So this is any kind of number that comes in higher than expected, or in this case, even though it ticks slightly lower, in the grand scheme of things, both CPI headline reading and core CPI are both at elevated levels. So if we do not see signs of those changing and actually starting to see sizable pullbacks in the near term, I think traders are always going to be fretting about, we could see a few more 50 basis point hikes from the Federal Reserve in the next few months. And that's what's really driving markets at the moment. And in this case, it's driving stocks lower, in particularly tech stocks, because after all, the tech sector in the US is relatively indebted compared to more traditional sectors, be it say retail or construction.
David, the question is how much are we going to see in terms of a downward slide, right? Because quite a lot of this was anticipated. People anticipated that the Fed would move very quickly to normalize. That was the commentary when Jerome Powell spoke after the last meeting as well. So none of this really is out of the ordinary. But you've seen a sharp fall since that meeting in the NASDAQ. I think the question that everybody's asking, even from our perspective here, is how far will it fall?
Well, the financial markets typically overshoot to the upside when things are positive, like we saw the strong performance in tech stocks last year amid the pandemic and the post-pandemic boom. It's worth noting, though, that we already were seeing declines in U.S. stock markets from a few months ago. Things were already coming off the ball in anticipation of higher interest rates. You're spot on to say that higher interest rates were expected, but it's to do with how many more 50 basis point hikes is what traders are questioning at the moment. In relation to how low can we go, well, as we can see, we've already fallen to kind of a 14, 15-month low on the Nasdaq 100. A similar situation. So apologies, it was the lowest level since late 2020 on the Nasdaq 100, about a 14, 15-month low on the S&P 500. In relation to how low can we go, Well, if the financial markets have taught us anything in the last number of years, particularly in the last 10 or 12 years, is that whenever a certain level of fear grips the markets, in this case, higher interest rates, rationale tends to go out the window and emotions take over. So I don't think we're going to be seeing any declines in US stocks anytime soon.
Thank you so much, David, for joining in. It was being pointed out that there is significant retail participation in the US markets at this juncture, higher than has been seen in the recent past. That indicates that there is